Hello, everybody, and welcome to the Public Podcast. I'm your host, Anne Berry, and with you today to break down the latest in streaming trends, ESPN's latest gambling deal, those rumors that at least part of the company might be up for sale, and so much more. Don't forget to like, comment, and subscribe to our YouTube channel. That's at Public Invest to stay on top of the in-depth interviews that help you keep your portfolio on track. Today, delighted to include in our conversation Jamie Lumley, analyst at Third Bridge. Jamie, thanks so much for joining. Let's get right into the good stuff because I feel the news around ESPN, parent company of Disney, has just picked up. So help set the stage for us, Jamie. Disney's recent earnings results, just looking at the numbers here, the company reported more than a 7% decline in Disney Plus subscribers for Q2 of this year. With this contraction in streaming, what do you see as Disney's strategy to try and get some momentum back in this category?
Thanks, Anne, and great to be here. As we look at streaming and Disney, there are a lot of interesting things to look at. And first, I think it's important to just contextualize those declines that we see within that decrease in streaming, because, of course, a lot of that is attributable to Disney Plus Hotstar in India, where after Disney lost rights to cricket matches over there, that's been one of the larger reasons for the hit. But even outside of that, if we piece apart within domestic audiences, with Disney Plus in the US, subscribers were down slightly. ESPN Plus has been seeing really slow growth, as has Hulu. So right now, where Disney is, they're still trying to straddle the line of maintaining the health of their underlying linear distribution networks, the cable channels, which have been a major revenue driver for so long, while then also building out the streaming platform, but increasingly starting to see some hiccups there. So right now, two things like ESPN. ESPN is a major differentiator for Disney. It is a huge behemoth in the sports world. It has been a staple of the cable business, but has been increasingly under pressure. And right now, Disney is looking through ways in which they can strategically advance for this part of the business so that they can either really capitalize on the streaming side or figure out a new way to approach distributing ESPN content with all of its very valuable sports rights, which will put Disney in the best positioning going forward. As we look at
So let's talk about that some more, Jamie, with those numbers, because there are some headlines that ESPN was thinking of launching a streaming service with a $25 to $30 per month price tag attached to it, which is double to triple almost what some of the other streamers are charging for their monthly subscriptions. Is that something you think is a feasible strategy for ESPN under Disney's ownership?
It's a good question. And here's what I think is important to keep in mind here. As we look at the price points of some of the other streaming options, by and large, most of them are not involving huge amounts of sports content on those platforms, and sports rights are the biggest factor for driving up the cost of that. What we've been hearing from our experts before a lot of the news around what an ESPN flagship streaming launch would look like, in order for the company to break even, it would probably have to be priced in the mid-20s. Longer term, there may be some movement on pricing there, but at the end of the day, these sports rights are so expensive that that's really what Disney needs to look at in order to have it break even. So although it might be cheap,
well, that's really interesting, Jamie, because what you're saying there, a little indirectly, but it's implied in what you're saying, is that Disney would look to price this specifically to make sure that it is break even or profitable. That's quite a different strategy from what it's done with its Disney Plus and what streamers like Netflix have done historically to get going, which is really invest and accept losses in order to get some momentum behind subscriber bases. So you're implicitly saying, but tell me if I'm misunderstanding, that with ESPN, they're playing a different game, and that's a profitability game out of the gate.
So I think you've hit the nail on the head. I think they'll certainly be aiming not to be necessarily incredibly aggressive in looking for the sort of margin they'll be able to get on that product. But overall, the streaming industry has changed. Across the board, prices have been going up at players like Max, players like Netflix eliminating their cheapest ad-free tier, Disney raising their other prices. Although they may not necessarily all perhaps be profitable now, that is where the industry is going right now. So that's probably why Disney's thinking about this for ESPN. They're looking at this pressure on pricing, on profitability. And that's one of the things top of their mind as Iger is working on this turnaround for that Disney segment.
Let's keep going on ESPN, Jamie, and then come back to the other parts of Disney. But since we're on the sports entertainment giant, the company recently made a deal with Penn Entertainment to build a gambling site called ESPN Bet. Where does that stand right now, and what does it mean?
This is a really interesting point. And really, I think there are a couple things to keep in mind here. One is just to start off how much of a departure this is from the traditional family oriented brand which Disney has into a full new area, which is definitely outside of what they're known for and what they're really would value historically. What this necessarily could look like, it means a few things. So for ESPN, again, it is such a flagship of sports in the industry. There is a whole lot of opportunity to build off of the audience that Disney has in that product to really see growth within the gaming segment. That being said, gaming isn't easy. If we look at players like Fox, they recently exited a betting arrangement. This is not necessarily the easiest thing, even if you have those sports rights. So how this could necessarily shape up, there are a couple of pitfalls there. But at the same time, there is, again, that opportunity based off of the base that ESPN has.
And Jamie, why is it not easy? Right? Intuitively, it feels like a natural extension of the sports content, of the live interaction, of the level of engagement that sports has that's atypical in some ways versus other forms of content. Why has gambling proven to be a more difficult extension of a brand than one might expect?
So we've been hearing a few different things from our experts. To start off, it's again just the patchwork legal framework which is in the US right now, and that it's legal in some markets, but it's not legal in all. So navigating that from both a regulatory standpoint and then also from a marketing standpoint makes it a little bit more challenging, where you can't necessarily have a one-size-fits-all approach, that national strategy, which makes it easier to roll out. Again, it's also a new, but it's incredibly competitive. There's some very well-established players there already who are early to the game with incredibly aggressive promotional strategies. So even for a player which has a lot of sports rights, it's still not necessarily facing a greenfield opportunity. There are already some players setting up shop there.
Let's talk a little bit more about the rumor mill. And the rumor mill, Jamie, has been suggesting that Apple or Amazon or both could be circling a strategic investment, including, not just an operating agreement, but capital infusion into ESPN. Some speculation actually that Apple in particular may just be looking to buy that asset outright. What are your thoughts on whether ESPN can live inside a technology company more than its success in living inside Disney?
So there are two things I think that are worth keeping in mind here. One is we've heard from our experts that when we look at how ESPN could factor in for Disney, there are a lot of reasons why they would like to hold on to it, at least in part, just due to the fact that it really rounds out the rest of their programming. It has the family-friendly content, it has young adult stuff. Hulu, the sports really bring in a different demographic, which is incredibly valuable. But if we look over to the other side of things, just circling back to the cost of sports programming, they're incredibly expensive. And this is why we've seen increasingly some big tech players like an Amazon pick up Thursday Night Football or Apple pick up some MLB games, as well as the MLS, that this is a thing which they are able to fund having these rights due to their underlying tech businesses and then make those economics work. That being said, long term, they do still need to see that sort of results and have the audience make that worthwhile. But because of their underlying differences in their business, it could make this work. If we look at Apple, they've been hesitant to make any acquisitions on the content front, but on sports, this is something which they are more open to when it comes to investment. So for them,
MLS being a case in point, right? Major League Soccer. Everyone's talking about Messi right now and the impact on Apple TV Plus. What are your thoughts on that?
Well, looking at the MLS, it's interesting, certainly, because as sports rights go, it is relatively cheap versus, the NFL Sunday Ticket, for example, which just went to Google. That's at $2 billion a year, whereas the whole MLS 10-year contract with Apple is $2.5 billion. So definitely a slightly different scale.
Right.
But at the same time, it still enables Apple to really have a foray into the space, see what they necessarily need to do to drive that sort of success. And then having a superstar come to the US and really drive up those ratings can't hurt either.
Let's talk a little bit, Jamie, just to round out the thought on Amazon. That today has particularly been getting a lot of attention. If you're sitting in Amazon's chair, what is it about ESPN that can be done to go through the Prime Video or the other content assets that Amazon has been building and buying over time? Where does this fit from a synergy perspective?
It's a good question. I suppose if we look at what Amazon has today, they have in Prime Video, they have the content, they have some originals, they have the library from MGM, which they acquired last year. And for the
Yeah,
sports rights, they have Thursday Night Football, but they don't necessarily have the same rounded about, more than once a week kind of content coming there. So what ESPN could bring through hockey rights, NBA rights, it brings a much more robust schedule of content, which could drive further engagement with the
interesting.
platform. What's also interesting for Amazon is just as we piece apart all these pieces, it is still unclear, and the company has not been particularly open about this on earnings calls about how video fits in with this. But looking at all the economics of how that
Yeah.
works, because obviously Prime Video is a benefit of Prime, but a lot of people have the membership more for the e-commerce side of things. But if we just look at this, Amazon's probably approaching ESPN as a real driver of engagement for the platform and really continuing to have that stickiness as well in building out a fuller season and continual 365 days a year of opportunities to be engaged.
Jamie, how much do you follow Twitch as part of Amazon's portfolio of assets? Is there any sort of synergy to be had over time between that asset and some of the sports that Amazon is looking to move into?
It's definitely an interesting point. Twitch was one of those moves which initially, when that acquisition took place, might have had some people scratching their heads a bit. But in looking at potential synergies, I mean, look, at the end of the day, these platforms are looking at the best way to drive engagement. If we look at what Twitch is known for and the streaming, that it has their very high engagement numbers, a fairly committed user base, a younger audience, which is something which all these platforms are really going for. There could certainly be some opportunities when it comes to integrating those sports assets in there and driving different ways to engage. What that might look like, it's a little hard to say. There's still a lot which needs to be worked out in terms of what these partnerships may look like, whether it's partial ownership, full ownership, et cetera, of ESPN's assets. But there could definitely be some opportunities there.
Let's shift gears a little bit, Jamie, and talk about other components of Disney's business model and go back to what you said at the beginning, which is the fact that there are parts of Disney that really are cash flow generative. You know, the old expression in old business models is the cash cow that is then funding investment in some of the innovative product lines like the streaming. Um, if you look at Disney's core content business, the Hollywood strike, the writers' strike, the actors' strike has been a cloud really hovering over both the streaming industry's head, but also over, movies and for more traditional releases. How do you see what's going on in Hollywood as impacting the timeline for Disney to maximize profitability across its core business and then, of course, try and do better in streaming as well?
So, in the near term, this is definitely going to have a huge impact. What we've heard from experts that we speak with is that first, if you just look at the films which are on the content slate for the remainder of the year, they're all being delayed, they're all being pushed back just because it can't be understated the impact that having actors and the creatives be on the late night talk circuit and in the marketing push will then have in the resulting success of those releases. So, just looking at the near term, that is a huge impact. For the longer term and what this may speak to, say, Disney's push towards profitability, even before the strikes were fully in swing, we were hearing that Disney probably would struggle to hit its profitability targets within its streaming segment within the timeline Bob Iger had initially laid out, just due to the fact that growth had been relatively stagnant in the US market. There's increasing competition from some of the other streaming players. So most likely a 2025 target would be more realistic than any time in 2024. And that was even before we have had these couple months of an impasse when it comes to the actors and the writers negotiating with studios. So if we look at then how this will also impact the timeline, there are a number of things there because also there could be a complete reworking of how residuals, how royalties will be paid out. It seems like at this point, by and large, the cost will be larger than the studios initially were planning for, but it's still hard to say because they are entirely reshifting this model from the traditional linear distribution, substantial ad revenue then being distributed back to creatives, to the streaming model where the data is very unclear and it's uncertain how necessarily actors and writers will be compensated. So this is definitely one of those headwinds which Bob Iger will be thinking about considerably.
So, Jamie, we've talked a lot about streaming. It's an area that is Moving quickly, let's just touch very quickly on Netflix before we get to other parts of Disney's business. 5.9 million net new subscribers reported for the last quarter of Netflix. Password crackdowns happened. The cheapest ad-free tier has gone away. Those were some of the levers that Netflix was pulling to get its growth ramped up again. With those gone or perhaps maturing, where do you see Netflix going next?
So as we look at Netflix, I think it's important to understand how far into the password crackdown we are, because initially management has talked about how there are potentially 100 million households that were sharing passwords. And although we look at the most recent quarter, there was those 5.9 million additions, there's still a lot of runway within that potential 100 million that they could tap into. What we've heard from our experts is Netflix could potentially ultimately get about 50% of those. So there might still be some growth left in that over the next couple of quarters. And if we also, circling back to Disney, look at how they are starting to think about a crackdown on password sharing, there does seem to be more optimism right now about how much an impact this could have, not just on a player like Netflix, but on the industry as a whole.
Let's go back to Disney, Jamie, and talk about some of those core cash flow generating businesses that have been around for a long time. Let's talk about parks. That division's performance experienced a real boost, with the unit seeing 13% revenue increase. Strength in particular in the international markets. Jamie, this was a big post-COVID reopening focus area, the idea that folks would go back out and would be flooding the Disney parks with their attendance and their dollars. What are your thoughts on the parks unit and its performance at this moment in time as we go into the back to school period and then the holiday period after that?
So looking at parks, I think based off the most recent earnings, a lot of people are breathing a sigh of relief because there had been a lot of stories domestically about decreased traffic to these parks, concerns around pricing, and that ultimately might have been hurting the sort of traffic that they would be seeing. But as you mentioned, international was quite strong. Looking at year over year was an incredibly robust rebound in that part of the business. And domestically, although it wasn't quite the same amount of growth, it was still positive and fairly healthy. So Disney is still working out some things around pricing, finding out exactly what the elasticity looks like there, and then really just trying to have this still be a major place where consumers are deciding to spend their leisure dollars, as there's also the other dueling dynamic of people having built up post-COVID travel demand, looking to necessarily perhaps get out of the country. So looking at how they're balancing this, pricing is still key as Disney tries to find the right way that they can best optimize parks while also not driving people away from that major portion of their business.
Jamie Lumley, analyst at Third Bridge, thank you so much for joining us. We will keep tabs on what happens with ESPN as the suitors line up. So perhaps you'll come back when there's some advancement, if there is any, on whether or not ESPN is going to find a new, at least partial home. That'll do it, folks. Again, I'm Anne Berry, your host here on Public Podcast. Find us on YouTube at Public Invest, and see you next time.